All right, good morning, everybody. Things are in a little bit of out of order. Rearranged my office this weekend and swapped my two computers from the left side to the right side, and so everything just feels a little wrong. I get the hang of it in a few days. Brought back in the 42-inch for the 4-horse grid, which really isn't a 4-horse grid anymore. It's more like a 16, but yeah. All right, let's get this thing kicking off. So as usual, we want to start with anything that happened in the overnight hours, any sort of news that could affect the trading day. Because while we sleep, markets are running around the world, right? So, good place for that is Koifin. It's free. Yeah, you get what you pay for, but it has a nice collection between its Twitter collection and just top news. You can see it catches things from Bloomberg, CNBC, Market Watch. I know that those aren't like wow, amazing instant access news sites, right? But we're not looking for something like that. We're looking for a general outline of what happened in the overnight hours. Because if a ship gets stuck in a canal, for an example, right? Everybody remember that? Then it's going to be on every freaking news outlet. It wouldn't matter which one you got, right? So we're just looking for situations, events, things that got out of line in the overnight hours that could carry into today. Most of the time, there really isn't going to be anything in there, and that's fine. Don't look for something, right? Don't make something out of nothing. If there's nothing there, there's nothing there, then just move on. The times in history when there really is something there, like when that big ship got stuck in the canal, then it was top news and it was important, and then, it was everywhere. So simple, short, easy, effective. Nothing really kicking off in the overnight hours. With that same concept, whatever's happening in Europe right now, say the EV market is doing good or technology is doing good, whatever sector happens to be flush today in Europe, that's very likely the one that would carry over into our market. So when you're looking at how did Europe do, how did Asia do? Well, Asia's already closed, but Europe is still open. And their immediate market sentiment very often carries over into our market sentiment. So keep track of the sectors that are doing good over there in the morning. They are likely the ones that are going to do good here. By the same token, look at corporate events for the day. These events can be game changers, like when blockchain was having a conference and Riot finally left a lower range and became a game changer. That week, over the weekend, it was discussed on Seeking Alpha, and I pointed out to everybody, watch out, there's a big blockchain convention on Tuesday. And sure enough, well, that Tuesday, everything exploded. Uh, and I was ready for it, caught it. The corporate events can be something as simple as a new phone coming out. It can be something like Target reporting their Christmas numbers in January. It doesn't have to be some significant thing like an earnings. Most of these companies that produce some form of a widget will, outside of their earnings statement, still be producing new widgets or discussing subscriber numbers, production numbers for cars, right? Deliveries. So numbers come out. Keep track of the events that are going on out there. They're often a nice little heads up. Then we want to take a look at the economic calendar for the day. FX Street does a really good job with this from their highlighting example, right? It's one thing that I like about it. If you are not familiar with each of the different economic events that comes out, then you don't know which ones you should really be focusing on and which ones are kind of, not really a big deal. right? But if you go over to FX Street, they have these things kind of color coded by their impact expectation. Now, remember, just because there's an expectation of impact doesn't mean that there's actually going to be impact. What they're doing is they're looking back historically and saying, okay, when the Fed Williams does go out and have a speech, is he a bomb thrower? Does he like to incite uh, violence into the market? Or, if these additional auctions, by the way, they have them listed as non-impactful, but hopefully by now, anybody who's been listening to my morning briefings knows that these additional auctions are game changers. They are the midday play, the reversal that changes the entire ball game. Not always, but enough that you definitely want to know about it. So, Market Watch. If you don't want to go jumping around to all those different websites, you can just go to Thinkorswim, click on Market Watch, go to the calendar. If your calendar is really full and it looks like this, and you don't want to see all of this, uncheck the show all. That turns off everything. And then you can just turn on the Econo Day event. You can change these things by their column. And I usually grab the description and set it next to the time so I can see what time it is and what it is right next to each other. Short, simple, sweet. And if you're worried that you're going to forget, you can right click and set an alert. That alert will go to your smartwatch, your phone, they'll text you. It'll just pop up here in messages, right? All of that good stuff. So no reason to stress or forget. We do have manufacturing sales, but this one is an early glimpse for May. This is like the week to week one. So while it does carry a little bit of weight, it's not a game changer, right? So we definitely want to recognize that these are coming through. 8:15, 8:30, fine, those are on the table. It's the 11:31 today that I'm really watching for. At 11:30, we've got additional auctions, and these are the game changers. One of the nice things about this morning briefing is every single morning I show that screen. And if you're trying to go back and analyze what happened through a day, you can look at the morning briefing, fast forward into the first 3 or 4 minutes of that day, and you can see what was on the docket for um, analysts or for economic events or anything like that. Which means if you're trying to figure out like what happened here, was this a part of an economic event? There's no way to see. There's nothing here that would tell me that there were auctions here at 11:30 today, or that there was auctions at 11. But if you go back and watch the morning briefing, then you have a detailed record every single day of where those events were and what time they were, so that you could mark them out to try to help you analyze the price action that you're trying to put some work in on. Right? Nice little trick. It's an extra step. I get it. But when you're trying to identify a particular price behavior and you want to make sure that you're not seeing some event tucked into it, that's a nice way to do it. Since you can save your drawings on different layers, one thing that you could do is start. You always got to start somewhere. Start a drawing set, call it something specific like econ, and then begin drawing out where there is econ every day. And then save it on its own layer. That way you don't have to look at it when you don't want to, right? You can label these things, you can annotate on them, put in whatever you want. And that way you have a record so that later on, if you want to go back and look at what happened through the day, then it's already written down. You don't have to watch the video, do anything like that. No. Have my new cat in here trying to help me do the briefing, and she's not helping. One of three things can happen today. Either we stay range bound, we break to the upside, or we break to the downside. Thanks, Captain Obvious, right? I'm not telling you something you didn't already know. The ranges at this point would be the Globex high to the Globex low. That would be range one. Range two would encompass all of that and all of Friday as well. It would it would still be the same thing. It would still be range. And it would be from the idea that we are inside Friday's price action. So if you're inside of the previous candle, you're not trending. You're not going up. You're not going down. You're range bound. You're sitting right where you were from the previous day. This is a very large day. There's plenty of room there on each side for us to have some really nice price action. We could trend through this day, have trending price, right? Higher highs and higher lows, lower highs and lower lows. It still would be a range day. Because if we're sitting inside of Friday's price action, then we're sitting inside of yesterday's candle. Good school of thought. If the S&P, whether you're an options trader, stock trader, or you're trading the futures, if the S&P is sitting inside of its own price action from the previous day, then 8 out of 10 stocks out there are going to have a muted day. They're not going to be breaking out and running, breaking down and crashing. They're going to do what the S&P is doing. So if the S&P is range bound, sitting inside of its own price action, then it's very likely that everything else will too. You'll get outliers. There'll be, a few companies moving on their own initiative because of whatever news that they happen to have. Earnings, maybe they came out with subscriber numbers, whatever, right? There's going to be outliers. But for the most part, if the S&P is range bound, sitting inside its own price, so is the rest of the market. On those days, if you attempt to try to take short-term swing trades or try to swing trade in the market, you're very likely going to get chewed up. Notice our Globex range is very close to yesterday's RTH range. So if you wanted to break this down into three different zones, our own Globex, yesterday's RTH, and then the entirety of yesterday, that would give you three distinct areas to set your alerts and to watch for first touch plays, pivot point rejections. Don't bite me, punk. Scenario two would be breaking through the top of yesterday's price action. We've got an ADR at 2.8%. We're only down 0.3%. We've got plenty of room to go. If we get it back above VWAP and we manage to reclaim our own Globex high at 40.41, then we could begin marching to the upside. There is a cyan line right here, and that is the 10-period daily moving average. It's really important to understand why I'm pointing this out. One, the 10-period is like the starting point. It's the midpoint on a basketball court or on a football field. Everything starts from the middle. When we were falling to the downside last week, we were outrunning the 10-period moving average. And when we get too far away from it, we often pause, consolidate, and we let that 10 catch up. This is why when we're already at the lows, we often don't want to try to short the hole, right? Because we've already traveled too far away and we have to let the market regroup. Well, we are regrouped. We're very close to that 10-period. From this location, we could have a significant move to the downside, an easy 5% move to the downside this week, and it wouldn't even be considered, quote, oversold, right? So it's really important to recognize that we're basically sitting in the middle of the court and that we could go either way in a significant distance without stretching too far beyond our means. Another reason that I'm pointing it out is if we are going to make an upside breakout today, breaking through the top of yesterday's price action, that 10-period daily moving average is right over our head, and we're very likely going to hit it and reject off of it at least once. First touch play. Knowing where that is going to be a game changer for you, so you don't try to go long right before price hits that 10-period moving average. Econ can always push price through one of those. Otherwise, you want to know where it is. It's resistance when we're underneath it. It's support when we're above it. It is a change in sentiment completely if we go from being underneath it to above it, because we go from being bearish to bullish. So just our location when we look at it tells us a lot about what's going on. Whether we're above it or below it, whether we're moving closer to it or farther away from it, all of that becomes a part of the analysis. Measuring out our ADR for today, if we happen to get through that 10-period moving average, we want to take our 2.85. Child, go. Take the 2.85 and subtract the 3%, would give us a 2.5, and that's going to be above the previous week's high. Right? So now we would be in an inside week breakout, because at this moment we're inside of last week's price. So if we break out of the weekly candle, you're definitely going to want to know about it. If we make an ADR move today, our full ADR, we will be outside of the entire week's range. That ADR move would put us at 41.11, one of the cog lines. To the downside, we're already down 0.3. And we're right at VWAP, by the way. So add 2.5 more to the 0.3 we already have. That gives us our 2.8. It's 39.09, which is really close to that cog line, 39.11. I would target the cog line of 39.11. It's also really close to an institutional pivot point, 39.14. So there's like this whole little zone down here from 39.15 to 39.09. And remember, when you're drawing your markers, imagine that you're using a fat, dull crayon, not a sharpened pencil, right? It's not about a thin line marked on the chart. It's an area or a zone. If we move our ADR, we will be outside of Friday's price action. So we'll have an inside day breakout to the downside, but we'll still be inside last week's candle. We're looking at a 10-day, 30-minute chart, and we are at the point of control. It's important to recognize that the size of the volume profile right now is pretty wide, right? There's been times recently where we've gone in here and it's been a very, very narrow point of control or value area zone. And right now it's pretty wide. It also is not lined up with time versus price, right? We got volume by time in blue and volume by price in green. A lot of times these points of control will be lined up with each other, and they're pretty close. We got a B-shaped volume profile in the TPO, right? Time, price, opportunity, the one in blue. That looks like it recently has built up enough that if we stay here much longer, we're very likely going to drop this point of control from 41.45, and we'll have a new one at 40.11-ish. The cog line at 40.11. So it's building out. If we make that break to the upside today, we've got an anchored VWAP at 40.66, and we have the value area high at 40.38, 40.39, right around in there. For the downside move, we have a volume profile value area low at 38.84. There's a slight level of volume, not enough to be any form of support. And if you're marking lines on pivot points, notice these pivots from last week, Tuesday and Wednesday, when we had these lows and kind of bounced off of them. They look like a place where we would want to draw a line, right? We've all done it. We see those lines in these previous days. I'm marking these areas here, and they look like areas that we would want to carry forward. If they are an institutional pivot point or a universal pivot, sure, you can bring them forward from that perspective, but you still have to recognize that they're just an open, high, low, close pivot from days ago. Very likely to have no real impact in price action. Just seeing a wick or a look left pivot and drawing a line is going to lead you into a false sense of analysis. You want to tie those lines in with something. The volume profile, TPO, something. Otherwise, just drawing a line against the wicks doesn't provide anything. For the 5-day, 5-minute, you can see that the previous week close lines up really close with Friday's intraday point of control. So we'll just leave those alone and consider them to be the same. There is an untouched point of control to the downside, really close to 3,900. An untouched point of control is a place where we're very likely going to see a reaction in price should we get down there and come into contact with it. That's why we always want to keep track of where they are. There is another one to the upside, but I don't think we're close enough that we would be able to hit it today. $41.16 is where the next one is. Oh, and there's one there, maybe. So we'll just shoot these forward and then come back and to the right, see where they're located. All right, so this one's no longer an untouched point of control. We got to it Friday, took that one out. When we zoom back a little more, we've got this one. That's still an untouched point of control. So there's something going on with volatility. Kind of wanted to take a moment to point this out. It's important for anybody who's trading options out there, but it's also important for any of you futures traders. Expected move, implied volatility, standard deviation, linear regression, it all ties together. When volatility isn't doing what we would expect it to do, it leaves us vulnerable to a misunderstanding in the market, that it can go a lot farther than we anticipated that it could, or that there's a false sense of calmness out there that isn't really there. Things like skew are directly connected to the volatility, mainly because of what volatility is reading and where those numbers come from. So when it comes to the amount of puts that are traded versus calls. That's where our skew comes in. When we're looking at the VIX and trying to figure out what's going on, whether we're in contango or whether we're in backwardation, and whether there's a change in market sentiment is a big part of the discussion. If we can't use the VIX to gauge what's going on out there, then we have to find something else. So on the screen right now, we're looking at VIX futures. And I just went in and changed the contracts out. We got M, N, Q, and U. And then V, X, Z, and all the way up into January of next year. Looking just at their price, we can see if we're in some kind of contango or backwardation. Contango is what's normally happening in the world. Things that are close in are cheaper than things that are farther away. So right now, our active contract is 28.55. We've got 29.20, and then things are going higher, 29.74, but then they start coming back down again, 29.67. Each consecutive month farther out should be higher up in value. So the U series should not be the same cost as the N series, right? And that's what we're looking at there. The Qs should be higher than the Ns, but they should be lower than the Us. When we look at this and we see that the front months are more expensive than the back months, that tells us that we're in backwardation. That's a first glance, just a quick glimpse of what's going on out there. If you go and look at these on something that charts it a little better, this is the futures right now for different days, different dates. So we got June here, and then we go farther out in time to December and into January of 2023. This chart should be moving from left to right higher across the screen. And instead, we got this little bit of a rise, and then it all just drops. So this is another way to visualize whether we're in contango or backwardation. We use this kind of information all over the place for all kinds of analysis. But one of the things that we use it for is trying to figure out what the institutions are doing or what very large traders are doing out there. We can identify their trading within the options as a gauge for their sentiment, right? Or if they're heavily buying puts or heavily selling puts, that would tell us a lot about their sentiment. It's common and natural and normal to see institutions sell more than they buy. Selling is a more guaranteed way to make a buck, right? You might not make as big of a, a profit as if you bought an option, but you have a more likely chance of winning. And they would rather win, even if the win is smaller, than take an exaggerated risk just to get a bigger payout. So it's common for them to sell to open, buy to close. So when we have exaggerated moves to the downside, what everybody normally would do is go in and sell puts, right? We've made a big expansive move to the downside, sell puts, let it rally back up off of those lows. We're not seeing that. It's not in there. It's not in the skew is representing that that's not happening. So when it comes to the skew, we can read a lot about what's going on out there and where they're putting their money, right? They can get on it, TV and talk all they want, but they lie, right? They lie. They say things that misrepresent what's going on, but their money doesn't lie. So follow the money. Or the NASDAQ. Same scenario. We're right underneath the VWAP. That would be a zone 1 from Globex high to Globex low. A zone 2 from RTH high to the Globex high. And zone 3 from all of Friday to the Globex high. Those 3 different zones would offer you downside pivot point plays should we remain weak, right? And if we stay inside of yesterday's price action, then it will just be a range day, and that would be our play. Beyond that, another scenario is that we can break to the upside. We do still have a 10-period moving average in this market, just like we did on the ES. It's right over our head. It's really important to understand where it is and what we expect out of it. First touch play, if we hit it, we're very likely going to bounce off of it at least once. If we get above it, what was resistance will now be support. And then there is the context of where are we on a daily chart. When we're looking at a daily chart, if we're above the 10, we're bullish. If we're below the 10, we're bearish. If we do break outside of yesterday's price action to the upside, we've got an ADR of 3.9. That's almost a 4% move. And we would yawn at that and say, yeah, it's not much of a move. The NQ is down nearly a 0.5%. If we mark a 4% move on the day, that ADR doesn't take into account the negative 4.1 that we're down. So 12.737 to the upside. And from that, it wouldn't even hurt to add the 4/10 that we're down. That would put us very close to, I'd call it 12.8, right? Without haggling or trying to get too fine of a point on it. 12.8 to the upside if we take all of our ADR today. Now, make no mistake about it. If we're going to make a run like that, if we're going to even get into a move like that, everything will light up. There will be nothing subtle about it, right? We're talking exaggerated size, things flashing on the screen like Christmas. It'll all be lit up. Your sectors will be in play, at least finance and technology. But you can bring the consumer discretion into that as too. It's XLY. Those are your three risk on sectors. You need at least two, right? The NASDAQ 100 does not have financials in it, but the S&P does have the financials. So if it's only the financials that are rallying, likely not going to see the play in the NASDAQ as much as you will in the S&P, but it's going to be across the board. Then there's the MOT. MOT is the acronym for Monsters of Technology. We talk about them all the time, right? The FANG names. If they're not doing good, nothing's doing good. If they go down, the market goes down. So keep your eye on that list of stocks. If you don't have Thinkorswim, you can't do this here, which is a conglomerate symbol. It's got Apple, Microsoft, all of these names, all in one chart, all in one symbol. Right? We just gather them all up and put them in there. Thinkorswim is the only platform that I know that you can do that. I'm sure there's others out there, but it's the only one that I know. So if you don't have Thinkorswim and you're trying to keep track of the monsters of tech, you're going to have to do it individually, chart by chart, which is fine. They're either all bullish or they're all bearish. Be careful of one that may stand out from the group. For an example, if Tesla reported numbers today and say it went down while all of these others were going up, then you would have a divergence within the monsters of tech. It's unlikely though, because if Tesla starts going to the downside, these others are very likely going to start going to the downside too. Still, individually, Nvidia could have news and start going up while the rest are going down, right? Or Google or Amazon, any of them. So on their own, they could break away from the group. But most of the time, they're all going to work in sync. They're all going to do the same things because they're all impactful. So keep track of the MOT. There was a lot happening in Bitcoin, and I'm not going to even pretend that I understand even half of it. But something broke. A lot of names got a significant beatdown. And one of my buddies over the weekend just made $20,000 trading into uh, one of the names, Luna. Yeah, trading into Luna. Luna went from $110 to like a fraction of a penny. And he threw some money at it. and it has been running ever since. So there's a lot going on in the coins right now. Be particular about what has been beaten down and what you're trying to buy back, right? I don't even pretend to understand the just different classifications of what's out there, stable coin and blah, I don't know. I just watch Bitcoin. I understand Bitcoin. I don't understand all the other coins. Having said that, there's a lot of places out there, even something like TradingView that has retail sentiment. I'm retail sentiment, right? I have an informed opinion about the market. I run this morning briefing. I give you my opinion about what's going on in this market. Find something like that for Bitcoin or altcoin or all those other coins that are having issues right now. There's money to be made over there, but you can't do it just by looking at some random chart. The reason that chart went down or the reason that it's going up is going to be directly connected to whatever the heck got broke, right? That's one of the main things right now that's going on. Find an informed decision or an informed opinion about it, whether you're getting it from Stock Twists or TradingView, whatever, right? Look for someone with a high rating scorecard, someone who the community has deemed to be knowledgeable about that topic. That's the one you're going to want to find, right? And it's not hard, right? It's like Yelp reviews. We were in trading last night, and this liquidation break to the downside in the S&P was directly connected with the bonds rallying back up. It was a nice reverse play, right? I was literally watching the bonds for confirmation of this move, and they were timely and insightful and helpful. These two have been coupling and then decoupling, coupling and then decoupling in the last few weeks. So it's not an always thing, right? Keep your eye on it. See if they're coupled or decoupled, and then use them to your advantage. Now, during the day, we got Tick, Tran, AD, U-Vol, Mark. We got all these other things that we can look at as well. But at night, we don't have even half of those things. So if you're trading in the Globex, it's something like the bonds and the dollar provide a lot more insight than just not having anything. For years, all I've heard is that oil is no longer big enough to be impactful in the market. And in the last few months, it has proven that bias to be completely false. Oil is big enough to impact the market, and its moves have been impactful in our market. And by our market, I mean the NASDAQ and the S&P. So there's a reason that these names are in the grid. These aren't the names that I always use, but this grid setup is the logic that we use. We want to see what's going on in the overall market, not just trade the one thing we're trying to trade, right? Like just the ES and bringing up an ES chart. Watch what's going on in the market. These names have been really helpful to validate a move or anticipate a failure or to get a trade of the day, right? It doesn't have to be the ZB. By the way, it's sometimes swap that off for the ZN. There's no wrong way to go here. Watch the bonds, watch the dollar. Remember that the bonds and the dollar are going to directly affect finance. So something like KRE and XLF ETFs are a representation of that finance. The S&P has a lot of finance in it. So you're seeing finance get beat down or start to get weak, then it's very likely that the S&P and the NASDAQ are going to start getting weak. The NASDAQ doesn't have financials in it, but it does have a lot of the same names that the S&P has in it, right? And the whole basket gets traded. The algos don't care. All right, taking a look at what's moving around out there, it may be easier to start with what's negative this morning. Bitcoin, USO, emerging markets. Now, we use emerging markets for global risk on, risk off sentiment. If that's down, we know that the global marketplace is not interested in taking risk on positions this morning. That can all change, right? If you haven't heard me say it, then you can. This will be your first, but the rest of you probably are tired of hearing it. When it comes to the market, what's going on a day-to-day basis, that global risk on, risk off sentiment sticks, right? It matters. So you want to see what's going on out there around the world. Finance is a little flat. Anything below a half, from 0% to a half of a percent to the downside, all of those names, they're not really enough one way or the other, right? Something can be down a half of a percent, then it gets on the radar. Less than that, not so much. That's a lot of wishy-washy names this morning. Then that's energy, finance, building materials, industrials. When we start getting right on the edges of that half a percent, we get into gold, tech, semiconductors, emerging markets, Bitcoin, all in the negative. So flip that around and start asking, what's positive then? If those are the negatives, what do we have that are positive? Marijuana is up this morning. Cloud computing, oddly enough. And now this one, don't trust this one. The way that TrendSpider works, and you always want to know what platform you're using when you're doing work like this. TrendSpider will record after hours price changes. And then, we have the weekend. We come back on Monday. Then we have pre-market trading. Well, if cloud computing has not had any pre-market trading, and we're still looking at the change from after hours on Friday, remember Friday was positive. We rallied up a lot coming into the day. We went into the close high on the day. Cloud being up 2.1 is very likely a reflection of the after hours change in price action, not the pre-market change in price action. If there hasn't been any transactions this morning in the pre-market on cloud, then it's still showing the last traded price, which was from Friday after hours. So we can't look at this and say, oh, wow, cloud computing is up over 2% at the same time that we recognize that tech is down, the Qs are down, everything is down. Why is cloud still up? Right? So be mindful of the program you use, what platform it is, where it gets its data from. The S&P old school 11 sectors don't represent things enough. So I like to go in and build my own. Say like the chip sector. All the chips in the chip sector are down. Or the crypto, right? We don't have an S&P 500 crypto sector, old school legacy, right? We've only got 11 sectors that we watch, right? There's way more than 11 sectors. We just watch those 11. So we want to break them down and make our own, right? Looking at the crypto list this morning, a lot of these are ETFs for specific types. And that's not normally what we would focus on for crypto. We would focus more on companies heavily vested in blockchain. That's why names like PayPal, Mara, NVIDIA, MSTR, that's why those names, AMD, that's why they're in the list. I didn't make this list, by the way. It came from the Smalls Exchange. If you wanted to trade crypto futures, you would want to know what is the basket of stocks that make up the crypto futures product. And these are the names inside that crypto product. Electric vehicles. Being able to break that down and see what's going on out there. A couple of legacy names like GM is down slightly. Remember, it's not enough. It needs to be at least a half of a percent. And Ford is up slightly. Again, not enough. It needs to be up more than that to even be something we would consider. NIO, XPEV, Liato are all looking really good this morning. At least they were in the pre-market. But again, it's that same discussion. Don't take that on faith. Make sure you go in and check, have they actually been traded this morning? Or are these still representing after hours moves from last Friday? Names that have moved around this morning: Ribbon, Ride. So little bit of both. Tesla's negligible this morning, not much of nothing yet. And then the pot stocks. We knew pot was up slightly because there's an ETF that we use for that, but that one ETF just doesn't do it justice, right? We want to go in and actually see the names in that list. What's up, what's down. Remember, everything can be broken down into industries or sub-industries. So when we say finance, what kind of finance? Credit cards, lending institutions, insurance, regional banks. The same thing with pot. If you go in and just say the pot sector, well, that doesn't really tell us much. Recreational, medicinal, real estate, CBD. So you want to be able to look a little deeper, recognize the opportunity. The intraday trading that I've been doing the most of is finance and energy. And that's not looking like it's going to change anytime soon, right? Finance and energy. We'll continue to say what we've been saying. Look at the names that are not yet beat down. If you're thinking about swing trades, think about things that have not fallen as much as the other names. Start getting into things like Apple, Microsoft, Johnson and Johnson. There's still a lot of names out there that have not taken the beat down. It'll be those names in swing trades that I would rather approach instead of things that are down significantly, 50% or more, right? Those names have already been beaten down so much, they're not really something I would be interested in focusing on. From that point of view, the Dow represents a lot of those big name mega cap stock companies that have not taken the significant beat down that we're looking for. Keep in mind the weight when it comes to what makes up the marketplace. These sectors that we talk about, information technology is almost 27% of SPY, but healthcare is the next biggest name on the list, 14.5%, and then consumer discretionary, and then financials. So while we talk all the time about consumer discretionary and we talk all the time about IT, information technology, the FANGs, MOT, market of the monsters of tech, we talk about those all the time. But you got to realize healthcare is the second largest sector in the S&P. That's one of our risk off sectors. It's a sector that we really don't focus on for a bullish day, but the names that are in there have enough weight to adjust the marketplace, right? They can't compete with the monsters of tech. No, but they are worth keeping an eye on, especially when you look at what hasn't fallen yet. I was trying to explain to someone who doesn't trade over the weekend why they should not go out and dump their entire savings out of the market. And at the same time, this weekend, in another conversation, I had to try to explain to somebody why this isn't the bottom and you don't want to go buy across the board in everything that looks like it's cheap and on sale. Neither one of those two perspectives are right. And both of those seem to be extremes on the edges, right? Don't get extreme. Should you start buying along these lows? Absolutely. If you want to slowly average your cost in, right? Cost average basis trading has been around forever. And there's a reason for it. It works. But you're going to take pain if you continue to buy while we're not yet rallying out. I'm fine with that pain. I understand exactly what my risk is, right? And I've been buying and I continue to buy a little bit at a time of all of the names that I want to someday give to my grandkids. That's the way it works, right? long-term investment, long-term hold. You buy when stuff is cheap. Be particular about the stuff you're buying, right? The airlines, the casinos, the cruise lines, they look like they're really good buys, but they have a horrible credit rating. Their cost just to borrow money is absolutely trash. They have no record of being able to manage money appropriately. Bad CEO, bad leadership, just bad businesses across the board. Will they come back, and are they cheap now? Yes and yes. Not anytime soon. On the other side of that, when we get out of institutional or investor language and start getting back into trading language, there is none of this buy the dip mentality. It's sell the rip, right? Not buy the dip. So every opportunity that the institutions have taken to participate in this market has been the sell side. Every rip gets sold into. They're holding a ton of these big names. And they can't just go out and dump these big names. They would literally crash the market. So they have to take every rip to the upside as another opportunity to unload more of it. And they're not done. So get the ideas of this being the bottom and we're rallying back out. Get all of that out of your head, because it's not the bottom. We're not rallying back out. We're not done. Bear markets do have upward price action. There's going to be days or even weeks where we go to the upside, that we could, in the S&P or in the Qs, revisit something like 420, maybe even 440 sometime this year. That's not off the table at all. That could easily happen. That doesn't mean we're done or that we're headed back up. And if you want an example of what I'm talking about, you have to disconnect trading from economy, right? From the market, from the economy. To do that, you have to go back to 0708 housing crisis or the dot-com bubble of 2000. In those situations, the global economy went down. It wasn't just the stock market was bad or that there was rising rates or any of these macro things. It was across the board. The entire global economy was negative. And then the market also was negative. Since then, when we get these 7 to 10% moves to the downside, these are just weak market areas. And the Fed came right in there and activated their little programs and ran it back up, right? The plunge protection team, which is a real thing. They just ran them back up again. Well, the tools that they use to do this, they can't use right now, because those kind of tools increase inflationary pressure. And inflation is what they're trying to solve, right? So they're literally getting the message out as hard as they can that they don't want people buying the dip. They don't want this market going up. And every time it starts to rally, they're going to go on TV and say whatever they have to say, throw in inflammatory bombs at the market to get this to start going back down again. They're not done. It's the plunge protection team in reverse. They're literally pushing the market down. So they're not going to come in and step in and buy this thing back up. They're not going to activate any of their tools to save this market. They're putting everything they've got into pushing it down, not up. And one of the reasons that I bring that up is because of the crypto situation. They bailed out the Lehman Brothers and Bear Stearns and that whole 0708 financial crisis. The government was right there trying to help and solve the problem. I'm not picking sides and saying that they did or didn't solve the problem, or that they did or didn't help at Dodd-Frank and all that other. I'm not getting in it. Just when it comes to the crypto, they're not going to step in and save it, right? They're not going to pull any strings and do anything that they can to try to help the situation. They're just going to stand aside and make sure they don't get any of it on them when it explodes. The contagion that was brought up by Morgan Stanley and Goldman Sachs is not the idea that crypto would crash and cause a contagion into the rest of the markets. It's the sentiment contagion that they were more worried about, that retail investors who just took a 50 to 70% gut punch in their entire portfolio may also decide that they're going to pull out the rest of that portfolio, right? That the contagion will be the behavioral side as a spillover. It was an interesting read. If you've got the Wall Street Journal or Bloomberg, or by now probably a lot of the other sites, you can just hop on Google and start looking for uh, Bitcoin contagion, and maybe put something like JP Morgan or Goldman Sachs behind it, because it was their analysts that were having the discussion over the weekend. So what I got for you guys. Be careful, be safe. I will see you all in the main chat room, 9:15. We'll get this day started.